Okay guys, so welcome to this video where we're going to have a look at the US dollar against the high yielding currencies. And when I say high yielding currencies, I'm talking about the emerging market currencies with higher interest rates in the United States and why that should really factor into the continued weakness in the dollar against the Russian ruble, the Mexican peso, the South African rand, and the Brazilian real in the market. So what we're going to look at first of all is how interest rates play a key role in a currency's trend in the markets. I'll give you some prime examples and then we'll break it down in more detail so you can understand how this plays out and why these trends should continue and why we have such a structural bear trend in the US dollar at the moment because of low interest rates and a negative current account balance in the United States, which will stay in play, especially with this huge fiscal stimulus package coming into the market. So once we get this understanding, then we can try to match up our trade ideas with technical strategies, getting to the market, use our 1 month volatility stop loss areas to protect ourselves from fluctuations, and hopefully just ride this trend out beautifully as it plays out in the market. So let's just remember, guys, the most important thing to remember, interest rates are a very key component to an exchange rate in the market. So here's an example that I have in this spreadsheet. We're looking at the Aussie dollar against the US dollar. I'm going to show you how the interest rate differential between two countries literally drive a trend in the market. We're going to look at the exchange rate, the Aussie dollar, US dollar from 1997 to 2021. So what we're looking at is a difference in interest rates between Australia and the United States. And then I'm going to explain this in more detail if you don't understand this. And then you're going to look at why the dollar is now structurally positioned for a weaker trend in 2021. And that's why the markets are selling the dollar. And these are why the 4 currency pairs I've chosen should be the best trades to play out in 2021. So what we can see is here, we have the interest rate differential between Australia and the United States highlighted in yellow. And then we have the Aussie dollar, US dollar exchange rate highlighted in green. Now, what you can see is what we're looking at is the Australian interest rate minus the US interest rate, because remember, the Aussie dollar is the base currency and the US dollar is a quote currency. So when we see the interest rate differential widening in favor of the Australian dollar, basically meaning that the Australian central bank's interest rate is higher than the US central bank's interest rate, we get a bullish Aussie dollar against the US dollar. And then when the interest rate differential starts to narrow and the Aussie dollar is no longer holding a higher interest rate over the United States, then we see the exchange rate start to dip to the downside. And then once the interest rate differential starts to widen again in the Aussie dollar's favor, we see the Aussie dollar strengthen against the US dollar. And then again, once the interest rate differential narrows, we see the Aussie dollar weaken against the US dollar. And when it strengthens again, the Aussie dollar strengthens against the US dollar. And then again, once the differential starts to narrow again and go lower, we see the Aussie dollar weaken against the US dollar. So you can clearly see from 1997 to 2020, this trend literally mirrors itself for the difference in interest rates, and then the trend plays out in the market. So 1997 to 2020, we're talking about 23 years. I'm showing you the price action really does play out clearly in favor of either buying the Aussie dollar when the interest rate differential is going in favor of the Aussie dollar, and then selling the Aussie dollar US dollar exchange rate when the difference in interest rate goes away from the Aussie dollar's favor and moves to more of a neutral situation between the two interest rate differentials, or when it starts to go in the US dollar's favor. So why does this happen? Why does these trends pick up in the markets? Now, just remember, when you're trading, for an example, if you're looking at the US dollar against the Russian ruble as a prime example, what we want to see is that we must remember, if I'm trading this exchange rate, and let's say I want to be, let's say I want to buy the US dollar against the Russian ruble, I have to first own Russian rubles. I sell my rubles in exchange to buy US dollars, and that means I can buy the US dollar. So I'm funding the US dollar by borrowing Russian rubles, selling my rubles in exchange to buy dollars, and then I'm investing in the US dollar. Now, if I want to buy the Russian ruble against the US dollar, I have to first own US dollars, and I sell my US dollars in exchange to buy Russian rubles so I can sell this exchange rate, because I'm selling the base currency, okay? So when I'm selling the base currency, I'm selling the US dollar, I'm buying the Russian ruble. When I'm buying the exchange rate, I'm selling my Russian rubles and I'm buying the US dollar. So it's always based on the base currency out of the two. So what does this really mean? This means that you must remember when you're looking at one country against another, we have interest rates in each country. So in the United States, if I go to the bank and I deposit money at the bank, which is the deposit rate, at the moment, I will be paid 0.23% interest over 12 months on the money I invest in the United States. So basically, if you buy the currency, you get paid 0.25% over an annual 12-month period. Now, if I borrow US dollars from the bank, I'm going to be charged around 0.23%. Okay, so there's the lending rate and there's the deposit rate. So this basically means if I buy the US dollar in the currency markets, I'll receive interest of 0.23% over 12 months. If I borrow the US dollar in the exchange rate, I'll pay out 0.23%. Russia's interest rate is 4.5%, so much higher than the United States. If I buy the Russian ruble, I'll receive 4.5% interest on the rubles that I purchase. And if I borrow the Russian ruble, I'll have to spend and pay out 4.5%. So remember, when I looked at the exchange rate, if I want to buy the US dollar against the Russian ruble, you are lending the Russian ruble to purchase the US dollar. But remember, the lending rate in Russia is 4.5%, and the deposit rate in the United States is only 2.3%. So obviously we can straight away recognize that if I buy the US dollar against the Russian ruble, I'm losing money overnight because I'm paying out 4.5% on the amount of Russian rubles I've borrowed to purchase and finance the investment into the US dollar, and I'm only receiving 0.23% interest on the dollars that I'm purchasing. So I'm losing money overnight. And if I was to buy one lot of Euro USD, so 100,000 units, for an example, I'm losing money because I'm only receiving 2.3% interest on the dollars I'm purchasing, but I'm paying out 4.5%. So I would lose over 12 months, $4,270. If I bought the Russian ruble, on the other hand, I'll be paid that much money over an annual 12-month period. And it works out as if I sell the exchange rate and I buy Russian rubles, I'm getting paid $12 a day, and I'm paying out $12 a day if I was to buy the US dollar. So clearly it's not profitable to be buying the US dollar against the Russian ruble, because every single night when I'm trading this currency pair over 365 days, I'm losing money if I'm buying the US dollar. I'm paying out $12 a day. If I'm buying the Russian ruble, I'm receiving that money into my trading account. So you can clearly see that if you're a smart investor, you wouldn't want to be buying a low yielding currency. When I say yield, I mean a low interest rate currency against a high interest rate currency. That wouldn't make sense because I'm losing money overnight. However, it's very profitable for me to buy the Russian ruble against the US dollar. Now, this explains why when I showed you the previous spreadsheet, why the Aussie dollar was getting stronger against the US dollar when interest rates were rising in the markets, because it's now paying me more money every single night overnight when I buy the Aussie dollar against the US dollar. And that's why money flows from the US dollar into the Australian dollar to get paid this overnight interest into my trading account overnight. And as that happens, it drives the Aussie dollar higher. So let's say the Aussie dollar US dollar goes up by 20%. Now you've made a 20% profit on that trade, plus you're getting paid the interest overnight that's increasing, and that's what causes trends in the market. This is why when the interest rate differential was going higher in one currency's favor, the money in this, the smart money in the market follows this higher interest rate payment, and we cause trends in the markets. And then when the interest rate differential narrows, investors are no longer going to be getting paid as much each day. So they come out of the trade and they profit from the trade at the highest price they possibly can. And the flow of money going in the opposite direction means the trend then reverses, and we get weakness in the currency pair, as we've seen here and we've seen here. So clearly, we only want to be buying currencies with a higher interest rate than another currency, because it doesn't make sense for us to lose money every single day when we're holding a low yielding currency, which is a low interest rate currency, against a currency with a higher interest rate. It doesn't make sense. So the smart money is not going to want to lose money every night, overnight. They're going to want to be making money overnight. So they always buy the currencies with a higher interest rate differential. Okay. So how does this play out right now? Let's have a look at the interest rate difference between the United States and these four currencies. So at the moment, if we go back, we can see Russia has a 4.5% interest rate compared to the United States, small 0.23% interest rate. Mexico has a 4.5% interest rate, the United States, compared to US's 0.23%. And then we have South Africa's interest rate 3.5% compared to the United States. And then we have Brazil's 2.3% interest rate against the US's 0.23%. So clearly, Brazil's interest rate is higher. South Africa's interest rate is higher. Mexico's is higher. And so is Russia's. So if you can understand what happened in the early parts of the year for why these currencies did get weaker against the US dollar and why they should now reverse, we can understand why we're now seeing the Russian ruble strengthen against the US dollar. At this moment in time, we're seeing considerable strength in the Mexican peso against the US dollar. Look at this bearish downtrend we're seeing in the markets at this moment in time. We're seeing the South African rand strengthen against the US dollar very strongly. And we're seeing the Brazilian real now starting to strengthen against the US dollar. Now, the most important thing to remember is this. The United States has low interest rates, okay? That's one factor going against the US dollar because I just explained it. The other factor that's going against the US dollar is the fact that the US dollar has a negative current account balance. Now, when I say current account balance, just think of it in this terms. The United States is exporting $1.4 trillion worth of goods to the rest of the world. So they're selling their goods to the rest of the world, and the rest of the world is paying for those goods in US dollars. So that's money coming into the United States. But the United States is importing $2.4 trillion worth of imports into the United States. So the US is having to pay for those imports and they're sending dollars abroad. So clearly, if you're buying $2.4 trillion worth of imports, but you're selling only 1.4, there's a negative balance in your current account. Okay, so there's basically imports minus exports. So more money, more US dollars is going to the rest of the world than dollars are coming into the United States. And when you look at an exchange rate, what an exchange rate is valued at is rest of world US dollar reserves versus rest of world Russian or Brazilian currency reserves, and then you exchange those two reserves as a ratio to get the exchange rate. So clearly, if the United States is sending more money abroad every single year, and then Russia is sending money abroad because Russia actually has a positive current account balance because their exports are 400 billion, but their imports are only 200 billion. So more money is coming into Russia, then more money is going out of Russia. And when you compare those two as a ratio, then that means the Russian ruble should be getting stronger. Now, you've got this huge fiscal package going to be spent in the United States. So the US government spending $2.4 trillion expected in a fiscal package to save the US economy once Joe Biden's administration comes into office. And that means that all those dollars flooded into the United States will end up finding their way abroad because they always import more than they export. And that means the rest of world currency reserves of US dollars will be increasing even more. And then when you're comparing rest of world US dollar reserves against other currencies as a ratio, that weakens the US dollar even more, especially when you get countries like Russia, whose main export is oil, and the oil price is rising. So more money is going to be coming into Russia when their main export is going up in value. And that decreases Russian rest of world currency reserves, and that pushes the currency even higher in value against the US dollar. Look, Russia's main export is oil. That's 56% of all of its exports is oil. And as we can see right now in the market, oil is bullish and on a very strong uptrend because the outlook for oil is improving, because this vaccine will mean that transportation will pick up again. Airplanes will be flying as borders reopen fully around the world, and oil demand will increase, especially as OPEC is cutting supply. So that means we have two factors going against the US dollar, against the Russian ruble. We have interest rates, which means buying the US dollar is not favorable against the Russian ruble, and we have higher oil prices. So this is the reason why we're in a short trend sell at the moment. We're in a profit, and this is why the Russian ruble is getting stronger against the US dollar so far, around 8% from the highs that we saw in the early parts of the year. So fundamentally, let's think of it this way. Are you going to buy the US dollar against the Russian ruble and lose money overnight? No, you're not. Why would the US dollar get stronger against the Russian ruble if the US interest rates are going to be higher than Russia, which is not the case at the moment because inflation is extremely low in the United States. The only reason the US dollar got very strong against the Russian ruble in the early parts of the year was obviously because oil prices slumped so aggressively, and now there's a recovery in oil prices. We expect the Russian ruble to strengthen against the US dollar. So there you have a trend set up structurally for a strong ruble against a weak dollar based on low interest rates in the United States, meaning you lose money overnight, a negative current account balance in the United States means that it's not profitable to be buying the US dollar against the Russian ruble. And we should see the Russian ruble hopefully continue this downtrend, and we could see the Russian ruble potentially even go back to where it was trading in the first parts of the year. That's a 20% move in the, or actually no, from the current price, it's around 17, 18%. Plus you're going to be receiving that 4.5% interest on top of this exchange rate value. So the currency pair can go up 17%, but then you're also going to be receiving that 4.5%. So we're now looking at a 22% increase in your trade if you hold this over an annual 12 months. So that makes this currency pair very attractive to trade in the market. So clearly now you understand why the Russian ruble could be getting stronger against the US dollar. Again, Mexico, why would the Mexican peso be getting so strong against the US dollar? Again, the interest rate differential means selling this currency pair is very attractive because you get paid this amount of money into your account on an annual 12-month period. You're receiving money overnight. You're not losing money overnight if you're buying the US dollar. And again, the US has a negative current account balance. So it structurally sets up a downtrend in the markets. And that's why the Mexican peso is now gaining back all of the losses it previously made in the year. And why did Mexico incur these losses? Because the United States buys 77% of all of their exports. So when the pandemic first hit the global economy and the United States shut its borders, then obviously this caused Mexico's exports to be in low demand. The currency highly was sensitive to this and it got weaker. But now the global recovery is picking up. All these dollars are going to be coming into the US economy from the fiscal package. The exports will be in higher demand to the US. The US buys more than it exports, and that structurally sets up again a downtrend in the market. So we can understand the downtrend, and I've been setting videos about this all for the past few months. This is a short sell I'm in right now, and we're in profit. We should just hold this trend and understand that the difference in interest rates, as well as the US's negative current account balance, should push this currency pair further to the downside. Again, we can move on now to the South African Rand. Again, same situation in South Africa. We have a higher interest rate, 3.5%, negative current account balance in the United States. It structurally sets up a bear trend, which is playing out nicely right now. I'm also in a short position with my members in this trade. We're in a good profit, and this should continue to the downside. And this is structurally why the emerging market high-yielding currencies are predicted to continue to strengthen against the US dollar based on this understanding. And then we have the Mexican peso. Then we have the Brazilian real, which is starting to strengthen. And again, higher interest rates in Brazil, not as strong than the others. And that's why you could say the Brazilian real hasn't strengthened as much against the US dollar as the other currencies have, because the other currencies are more profitable. If I buy the Russian ruble at 4.5% interest, if I buy the Mexican peso at 4.5% interest, if I buy the South African rand at 3.5% interest, I get more for my money when I hold this trade overnight compared to the Brazilian real. And now you can see why the Brazilian real isn't as strong as the other three trades, but this still can play out in the market. So if we're going to sell these currency pairs, what we need to remember is how much of these currencies fluctuate on a monthly basis, so we know where to put our stop loss. And what we can say is that we can have a look at the Brazilian real against the US dollar, which on average fluctuates by 4.35% on a monthly basis. So if we enter the market here, we're going to want a stop loss of around 4.3%. I only got 10 minutes left, 10 seconds left, so I can't bet anymore. But there you go, guys. You understand the trades. Sorry, the video ran out of time.